This is Nightly Business Report with Sue Herrera and Bill Griffith.
February gains 2 months into 2019, and the stock market is heating up, making this one of the best starts to a year in decades.
Delinquencies rise, cars are getting more expensive, and a new report shows a growing number of borrowers are failing to make their monthly payments.
A fake review crackdown, a groundbreaking settlement for the FTC. But do companies need to get a better grip on what's posted on their websites? Those stories and more tonight on Nightly Business Report for Thursday, February 28th.
Good evening, everyone, and welcome. I'm Sue Herrera.
And I'm Tyler Matheson, in tonight for Bill Griffith. And we begin tonight with that hot market. February is in the books, the month that brings us Valentine's Day. Saw investors fall in love with stocks. Just look at the numbers. The three major indexes all posted solid gains. Look at those numbers, extending the rally that has taken over Wall Street for much of 2019. That rise came despite a pullback in today's session. That one saw the Dow Jones Industrial Average fall 69 points to 25,916. NASDAQ down 21, and the S&P 500 was off 7. Mike Santoli has more on the February rally and what March might bring.
Wall Street's rebound rally slowed in February, but it didn't stop, giving stocks one of their strongest ever 2-month starts to a year. February's gain in the S&P 500 leaves the index up by about 11% so far in 2019, only the fifth time in 70 years that the market was up double digits through the first 2 months. In past years, when stocks have been up in both January and February, further gains have been typical over the remainder of the year, though there have been some jarring exceptions, such as 1987, when stocks continued to soar into the summer before succumbing to a dramatic crash that October. The strength in 2019 has largely been a sharp snapback from profound weakness late in 2018, which saw the worst December since the 1930s on a mix of severe U.S. slowdown fears and worries that the Federal Reserve would keep raising rates and hasten a recession. A new message of patience from Fed officials helped a beaten-down market recover to within about 5% of its September record high. This despite continued expectations for a U.S. economic slowdown and sharp cuts to corporate earnings forecasts for the first half of the year. The Fed's gentler tone and lack of worrisome inflation have helped Treasury yields remain near one-year lows, making dividend-yielding stocks appear more attractive to investors. Entering March, a big question is whether a trade deal with China will be reached and whether, in fact, one has already largely been priced into stocks. A deal that allowed industrial companies to raise profit outlooks could help support stocks after their recent rally, which has appeared to tire a bit over the last couple of weeks. Today's stronger than expected fourth quarter report on U.S. GDP further calmed recession fears, but raised the prospects of a give-back in growth this quarter, which might not be the worst thing for a Wall Street that has made a fragile peace with the current slower growth, lower rate backdrop. For Nightly Business Report, I'm Mike Santoli.
The economy continues to hum along at a healthy clip. Fourth quarter gross domestic product came in better than expected, and growth for all of 2018 was the strongest in years. Steve Leisman is in Washington tonight.
The U.S. economy registering pretty strong growth in the fourth quarter, stronger than expected by economists and stronger than potential growth. It came in at 2.6%, while Wall Street was looking for around 2%. How did we get there? Well, the consumer ended up being stronger than had been forecast, and business investment was pretty strong at 6.2%. Residential investment, that is the housing market, did subtract from growth, and federal spending only ended a bit, up 0.4%. While the number was strong, it was a sequential weakening from the third quarter, and especially from the 4.2% number registered in the second quarter. Economists surveyed by CNBC expect the first quarter to be weaker still at 1.9%, which is just around potential growth. One of the reasons that weakening is expected is because inventories were very strong in the fourth quarter, perhaps built up by companies trying to get ahead of the tariffs and those goods landing on American shores in December. That's supposed to run off perhaps in the first quarter. JP Morgan, in fact, says inventory data have surprised to the upside. This development also may pose a headwind for GDP growth this quarter. The year-over-year growth rate was 3.1%, and the administration took that as a victory. Larry Kudlow, the director of President Trump's National Economic Council, expects the strong growth to continue in 2019.
So people are saying, well, there's a sugar high 1 year, that's it. They're just plain wrong. These policies are working. So I'm going to say 3% 2018, and I'm going to say 3% for 2019, and 3% as far as the eye can see.
As for the Federal Reserve, this number probably changes their outlook very little. They expect the economy to weaken this year and are concerned about some risks like global economic weakness and trade tensions. They'll wait to see how those issues play out before making any changes to their policy either way. For Nightly Business Report, I'm Steve Leisman in Washington.
Let's turn now to Brian Nick to talk more about the economy, the market, and some areas where you might want to put some money to work. He's the chief investment strategist at Nuveen. Brian, welcome. Good to have you with us.
Nice to be here. Thank you.
You know, 2 months do not a year make, but it's been a pretty good year in 2 months. 11% gains for the S&P 500 so far this year. Does that argue that maybe the best gains of the year have already been booked and that I might get a little more cautious?
Yeah, we think so. We came into the year relatively cautious with respect to our expectations, and I think it's fair to say that January and February have exceeded those expectations. But we don't think we've necessarily hit highs for the year, but we do think most of the returns for the year, at least in the United States, are likely behind us, and that's caused us not to get out of stocks or to go to cash, but to become somewhat more selective and defensive in terms of where we're putting money to work.
What about the fact that around the globe we're seeing slowing economies, and eventually that does impact us here at home? How big a factor is that in your forecast, if at all?
Yeah, one of the reasons that we think that growth's going to slow in the U.S. in the first quarter is that growth overseas has been slow. So that export number that was pretty strong in the fourth quarter GDP report is probably not going to be as strong in the first quarter. So we spent a lot of time looking for signs of a bottom or of a soft landing in economies like China and the Eurozone, where the data has continued to get worse in most cases. If you look at factory output in China, it just hit a 2 or 3 year low. In the Eurozone, we have German factory output, again, plunging month after month. So we are anxiously looking for a bottom in those economies before we become more optimistic about a bounce in U.S. growth, both economic growth and earnings growth.
Let me take you back to that comment you just made a moment ago, and that was the idea that maybe you want to get, not go to cash and get out of stocks, but be a little more selective, maybe a little more defensive in the equities that you put in your portfolio. What does that mean in practical terms? Does it mean less tech and more healthcare and consumer durables? And in healthcare, what kind of stocks are you talking about? Because that's a big, broad sector.
Sure. So that's exactly where we're positioned. And I think if you just arrayed all these sectors by what's the most cyclical, in other words, what's the most likely to do well when growth's accelerating, to most defensive, which is what's most likely to do well in a recession, we're somewhere in the middle because we think growth's going to be around that 2 to 2.5% level this year, a decline from last year, but not a high chance of a recession. So we're not in utilities or REITs, which tend to be the most defensive, but we're not in industrials, which have been the most cyclical and then the best performers. Healthcare tends to be a relatively solid area of defensive growth. That's been kind of our mantra this year. Within healthcare, you obviously have some kind of more highly valued stocks that are tied to, say, biotech, and then you have the insurers and you have the medical device companies. We're more conservatively positioned within there, as we are within tech too. So less cyclical and somewhat more kind of structurally secular higher growth rates in terms of earnings, but not going for those stocks that were extraordinarily highly valued and that had been such outperformers for the last several years.
Thank you very much, Brian. Great to see you. Brian Nick is with Nuveen.
Thank you.
And as Brian Nick just mentioned, new reports out of China do indeed point to some economic challenges. Factory activity in that country fell to its lowest level in 3 years in February due to weak global demand and the Lunar New Year holiday. A separate report showed growth in disposable income slowed in China as well last year. This as the cost of living rose, and that's resulting in fewer sales of things like cars, electronics, and home appliances.
And in Vietnam, the summit between President Trump and North Korean leader Kim Jong-un came to an abrupt end. Eamon Javers reports tonight from Hanoi.
The table was literally set for lunch in Hanoi on Thursday, but talks between President Trump and North Korean leader Kim Jong-un broke down before the two men could break bread. Staffers scrambled to cancel the lunch as well as a planned signing ceremony in Hanoi as the president explained why he walked away from the table.
Basically, they wanted the sanctions lifted in their entirety, and we couldn't do that. They were willing to denuke a large portion of the areas that we wanted, but we couldn't give up all of the sanctions for that. So we continue to work, and we'll see, but we had to walk away from that particular suggestion. We had to walk away from that.
President Trump insisted that relations between the two countries remain good, despite the failed summit.
This wasn't a walk away like you get up and walk out. No, this was very friendly. We shook hands. There's a warmth that we have. Now, I hope that stays. I think it will. But we're positioned to do something very special. This has been going on for many decades. This isn't me.
The president indicated the North Koreans offered to take steps to shut down the Yongbyon enrichment facility where much of the country's nuclear effort is centered. But he said American intelligence is aware of other facilities that the North Koreans were not offering to dismantle, and that's why he couldn't agree to lift sanctions. For their part, North Korean officials insisted they only asked for partial sanctions relief, and they called their proposal realistic. As Air Force One lifted off early from Hanoi on Thursday, the future of the nuclear talks remained unclear. The president said it could be a long time before the two men see each other again. For Nightly Business Report, I'm Eamon Javers in Hanoi.
It is time to take a look at some of today's upgrades and downgrades. Toll Brothers was downgraded to in line from outperform at Evercore ISI. The analyst cites a slow start to the spring selling season. The price target is $38. The stock fell 2% to $35.60. The firm also downgraded rival home builders D.R. Horton, KB Home, and Pulte Group for primarily the same reason. HP was downgraded to underperform from buy at Bank of America Merrill Lynch. The analyst cites cash flow headwinds and the risk of an incremental PC slowdown. HP reported a revenue miss last night. The price target is $19. The stock fell 17% to $19.73.
And still ahead, revving up risk. Cars are getting bigger and more expensive, and so are all those auto loans. Uber and Lyft will reportedly offer cash bonuses to some drivers with the option to use that cash to buy IPO shares when the companies go public. According to the Wall Street Journal, the longest-serving or most active drivers would be eligible for the programs. It's a rare move that lets individual investors access some of the most anticipated IPOs in years.
Some disturbing news today. Pedestrian deaths have hit a 28-year high. The Governor's Highway Safety Association said distracted drivers and distracted pedestrians are contributing to the rise. Another factor is the growing number of SUVs on the road, and they are bigger and heavier than sedans.
We also got new data on auto loans today that is renewing concerns the American consumer may be struggling financially. The percentage of buyers behind on car payments by a couple of months ticked higher in the fourth quarter. Phil LeBeau has the details.
It's getting a little tougher for some car buyers to make their monthly payment. The credit firm Experian, which tracks millions of auto loans, says the percentage of borrowers missing payments for more than 2 months edged higher at the end of last year. Just under 1% of all auto loans were 60 days delinquent, still well below the rate seen in the last recession. But with the average amount borrowed climbing to a record high above $31,000 and the average loan amount also hitting a record high of $545 a month, there's concern Americans may be getting overextended, taking out bigger auto loans than they can afford.
We don't want to paint too dark a picture here, but the bottom line is that the trend is not our friend when you think about that the economy is really strong. Why are people falling delinquent on their loans when we're creating 300,000 jobs? That's the question everyone should be asking themselves.
After the best 4-year stretch of auto sales the U.S. has ever seen, there's still a healthy appetite for new models, especially trucks and SUVs. And that's the reason consumers are borrowing more money. Those bigger vehicles come with bigger price tags that keep climbing as automakers add more technology and features. In fact, the average amount paid for a new vehicle has jumped 41% since 2010. And the news is not much better when it comes to used cars. Late last year, The average loan for a used model topped $20,000 for the first time ever.
Higher prices are not slowing down demand for pre-owned models. Last year, an estimated 40 million used cars were sold in the United States, and that number is expected to move slightly higher this year. Phil LeBeau, Nightly Business Report, Chicago.
The world's largest brewer is focused on drinks with less alcohol. That's where we begin tonight's market focus. Anheuser-Busch InBev said sales from beers with lower or no alcohol grew 8%. The company plans to grow that figure to 20% by 2025. That demand helped offset a decline in sales of its flagship Bud and Bud Light beers in its most recent quarter. Shares of Bud rose nearly 5% to 78.16. Struggling retailer JCPenney reported better than expected earnings and revenue. The company said it was able to reduce the glut of unsold inventory. As part of its turnaround plan, it will close 18 stores this year, and it will shut 9 of its home and furniture locations. JCPenney surged more than 22% to $1.52. Horizon Pharma has said that it's had positive test results for a drug designed to treat thyroid eye disease. 83% of patients in the late-stage trial showed improvement, compared to less than 10% with a placebo. If approved by the FDA, the drug will be one of the first on the market to treat the disease. And Horizon's CEO said the results are significant.
This is a great day for patients with thyroid eye disease. And if you look at this disease, it typically occurs where patients' eyes begin to bulge due to inflammation, causing it difficult for them to close their eyelids. They get dry eyes. And if you ask them, they say closing their eyes is like rubbing sandpaper over their eyelids.
The news sent shares soaring, up nearly 33% to $29.01. The drug maker Bristol Myers Squibb is coming under increasing shareholder opposition to its proposed $74 billion takeover of the biotech company Celgene. Activist investor Starboard Value called the potential deal, quote, poorly conceived and ill-advised, end quote. Just a day after investment firm Wellington Management criticized it as too risky and expensive. But Bristol defended the deal, saying it would create significant benefits for shareholders. Shares of Bristol Myers were up more than 1% to 51.66. Celgene was down nearly 9% at 83.12.
Well, California's largest utility, PG&E, took a $10.5 billion charge linked to last year's deadly Camp Fire and says there is, quote, substantial doubt over its prospects as a going concern. In a filing, it said it wouldn't be able to provide operating earnings guidance for the year, given the uncertainty over its liabilities. The company filed for bankruptcy last month. PG&E fell more than 4% to $17.03. Nordstrom reported better than expected earnings, but revenue was a little light. The retailer noted a double-digit rise in digital sales and said it plans to open new stores this year. Investors did like what they heard, sending the stock up in initial after-hours trading. And the Gap plans to split itself into 2 independent publicly traded companies, with Old Navy becoming a standalone firm. The other company, which is yet to be named, will consist of the Gap brand, Athleta, and the Banana Republic brand. The retailer says the split will allow the companies to have separate strategies, and that sent the stock sharply higher today in initial after-hours trading, as you see there.
YouTube is disabling comments on videos with minors following reports of an active pedophile network in the comments section. YouTube outlined its strategy to combat the issue in a blog post. The company will also launch a new tool that it believes will be more effective at identifying and removing predatory comments.
A Federal Trade Commission investigation has led to its first ever settlement related to fake online reviews. The agency alleges that a third party was paid to post false reviews of a supplement product on Amazon. The FTC says that when a company buys fake reviews to inflate its Amazon ratings, it hurt both shoppers and companies that play by the rules. Amazon said that it is pleased the FTC is taking action. But a recent study shows that the practice is widespread. 30% of Amazon reviews are fake or unreliable, according to the study. 52% of reviews posted on Walmart.com are, quote, inauthentic and unreliable. Other studies show the problem could be even worse.
So, what can companies do, like Amazon, to crack down on fake reviews on their websites? Joining us to talk about that is Eric Gordon, a professor with the University of Michigan's Ross School of Business. Welcome back, Eric. Good to see you, as always. What can companies do What can companies do to combat this? I mean, they obviously need to do something, given the percentages that we just cited here. What can they do?
So companies like Amazon have amazing data analytic capabilities. So far, they've used it mostly to generate data to convince companies to buy ads on Amazon. They need to divert some of that money and turn more of their attention to real-time data analytics to spot the patterns, the predictable patterns that indicate that these reviews are fakes. For example, typical fake review. It's great, 5 stars. That's, with no explanation about why it's great. So the Amazons, the Walmarts, they have to invest more of their expertise into cleaning this up.
So is what's going on here, Professor, the idea that the company that has a product, a diet supplement or something else, is actually paying individuals to post these reviews and write them up and submit them, thereby inflating their rating, which drives in more business, which helps not only the seller of the product, but it also helps the online company, be it Walmart or Amazon.
Yes, that's exactly what's going on, much to the surprise of most of us. So the whole premise for most of us is if we read a review, we think it's from somebody like us. We think it's not an ad, and therefore we trust it. So it's sneaky, but it's very powerful. It influences how high up a product is, in the first screen that you see so that you don't have to scroll down. And it influences us to think, wow, this must be really good. These folks really liked it.
Should the company, say an Amazon or a Walmart, should they be held responsible for those reviews, especially when it concerns maybe a diet supplement or something else that could affect people's health?
That's a tricky thing, Sue, because if we hold them responsible for everything there, I don't know how anybody could humanly do this. But I think they have to rise to a higher standard. Mm-hmm. They have to say, well, it's just as important to clean up these fake ads as it is to go out and sell the ads.
Nice to see you again, Eric Gordon with the University of Michigan's Ross School of Business. Thanks. And coming up, why some are in for a surprise when they file their taxes. There has been a lot of talk recently about smaller refunds this tax filing season, but today the Treasury Secretary said they are starting to rebound.
Tax refunds are up 17% week over week. That basically gets us to the same level as last year. And I would just emphasize, even if people had perfectly done their withholding, and I think withholding is complicated, we encourage people to go to the withholding calculator, people really should be focused on they're paying lower taxes. And those lower taxes is money back into the economy, and that's why we have the economic growth we do.
And it was that issue of not changing paycheck withholdings that caught many by surprise when they went to file their taxes. Sharon Epperson has more from Harrington Park, New Jersey.
Eat a little something because we are going out tonight.
63-year-old Joe Carley and his wife Cheryl were always happy to break even on their tax return. They rarely got a refund, but also never had to write a big check. After the major tax law overhaul, Joe sought the help of his financial advisor.
This is the section that's changing the most.
Who delivered some bad news.
We are going to owe more this year than in prior years.
Nearly $4,000 more. His reaction?
A little dismayed, to say the least.
The Tax Foundation estimates 80% of filers actually paid less in taxes in 2018 because of the Tax Cuts and Jobs Act. Only 5% saw their taxes go up. Still, many people are surprised when they do their taxes, finding out they're getting smaller refunds or they owe. One reason that's happening, under the new tax code, withholding tables changed. Companies lowered the amount of federal taxes taken out of employees' paychecks, giving them more take-home pay, maybe too much more.
Unless you went that extra step and said, okay, but what are all the other changes going to do to me as a taxpayer? What deductions am I going to lose? What is my tax situation going to look like? Maybe that decrease in withholding shouldn't have occurred.
Last year, the IRS urged taxpayers to check federal withholding amounts on their paychecks. Yet one study found only 16% did, meaning many weren't paying enough in federal taxes all year long, which is now impacting the amount of their refund. The new tax law also capped the deduction for state and local taxes. That's had a big impact on residents in high tax states, including many clients of New Jersey financial planner Michael Gibney.
That entire section is limited now to $10,000, where in the past that could have been $20,000, $30,000, $40,000, $50,000 for some people.
With other tax breaks limited or eliminated, millions of taxpayers are finding themselves in an unfamiliar situation, taking the standard deduction instead of itemizing, which may raise their tax bill.
Too, I suppose.
It did for the Carleys. So now they're planning how to manage their 2019 taxes.
One thing we have done is try to put a little more into a 401k to have a positive tax impact.
Making more retirement plan contributions may reduce their taxable income and lower their next tax bill. For Nightly Business Report, I'm Sharon Epperson, Harrington Park, New Jersey.
And that is Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
And thanks from me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we'll see you tomorrow.